Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. COVID-19 threw up a bunch of sectors which fell by the wayside, and it threw up a bunch of sectors which actually performed really well, contrary to what popular expectations would have been. Uh, Pharmaceuticals, information technology, specialty chemicals, and chemicals stood at the forefront over the last 6 months. And we've seen it in the results of some of the companies. Deepak Nitrite is one such company which has actually delivered very well in the first couple of quarters. The question to the management as they join us on Talking Point is about how do they see the sustainability of the business momentum that they seem to have developed at least in the second quarter, and how do they see growth in a post-COVID world. Maulik Mehtav joins us right now on Talking Point to talk about all of that. Maulik, good having you. Hope all is safe.
Hi, Neeraj. Thank you for having me on BloombergQuint. Things definitely are on an improving trend health-wise, and I hope that the country can stay as vigilant as it has been in the last 6 months. And if so, then certainly we are looking forward to a better future than the last 6 months.
Yes, and that's probably the most important thing. But let's try and focus a bit on the business of Deepak Nitrite as well. And then we'll come to the people's aspect, because I quite liked a couple of comments that you made on the con call. But first, the business, Maulik. Um, how do you assess the first half of the COVID-19 impacted period? Because there were opposing forces at play, right? Shutdowns, lockdowns, and therefore the production capability and the constraints for transport were there. But at the same time, the demand for a lot of products really shot up. So how do you assess the pulls and pressures of the demand and supply, and how did the first half fare for you versus how do you expect the second half to be?
Okay, so I think the first half, it definitely was a perfect storm of challenges. And what ended up happening is that a lot of decisions were taken on a tactical basis. So we had to put, a lot of the strategic long-term views not on the wayside, but certainly, the focus was more on the here and the now. So we had the petrochemical and oil fluctuations, we had the lockdowns, different for different states, of course, interstate transport issues. We had Nisarg cyclone in July, and we also had a very depressed domestic consumption in some of the sectors. And definitely did this affect all of our, performance engines and growth plans. And some of the expansions definitely got delayed because of manpower issues and movement issues. Price drops in many cases were out of sync with raw material volatilities. And in the chemical industry, what happened is that port availability, shipping availability also became a challenge in some of the months. What we did as a company is we studied how China got out of its lockdown in March, and we studied the challenges that they had faced, basis which we took a lot of decisions where we ensured that on the logistics front, on the port fronts, on ensuring supply of raw materials, we we went and overbooked certain aspects of it, and this helped us when we came back into production in May, after the government allowed certain industries to come back in. So other than that, on the strategic front, what happened is that before the COVID issues took place, we had been in discussions with a lot of potential strategic partners about new growth trajectories that would support both DNL's plans and their plans. And what we ended up doing around June is that we sounded a note of caution to these partners. We were not very confident about how the next few months would open up the Indian economy. And after that, we said, look, let's wait and see how July, August, and September pan out, and then we take a call. And happy to note that we have resumed those calls back in earnest. And so a lot of our plans are now at least back on an active discussion, and both sides of it are very committed to looking forward.
Okay, so we'll probably speak about that in just a bit, Maulik, and that's very heartening to know, by the way. But just before I get to the long-term trajectory, when I just look at the slightly near term, your earnings release does suggest that you are looking at a slightly stronger second half. At least the quarter three, the commentary looked like that. My question is, do you anticipate that it will be back-ended, or are you already seeing very decently strong earnings momentum in the month of October, which is quarter three, therefore?
So one thing I just want to mention, the big difference for us between quarter one and quarter two was that in quarter one, we were just not able to manufacture at capacity for the entire period. In quarter two, we were able to use all 3 months to manufacture. Nonetheless, in some of our products, we were not able to leverage our entire capacity because there were constraints that continued to hamper both movement and production. We always believe on being 110% on the right side of whatever government mandates are there in place. Now, coming to quarter three, we're seeing that the demand that was slow in many of the segments, particularly in the dyes and intermediate segments, it has slowly started to come back. Similarly, so in the performance products, where we look at the end segments of paper, detergents, and textiles. And so volume recovery certainly is on the cards. And if you look at Q3 versus Q4, as volume recovery is on the cards and we see an improving trajectory, it is natural to expect that there may be some tailwind that would make Q4 a little bit better than Q3 and Q3 a little bit better than Q2. And most of it, of course, has the caveat that we have to ensure that both raw material availability, manpower availability, and logistic challenges continue on an improving trend. If any of these become constraints, of course, at the end of the day, it will not be the end segment, it will be the availability. But right now, we believe that we are in a position where we can project certainly that Q3 will be better than Q2 and Q4 will continue on that trajectory of improvement.
Okay, so just one small clarity on the here and now before we get to long-term trends, Maulik, and that is, do you anticipate that FY21 would therefore not be a year which is completely gone or drifted away? You think that FY21 revenue, operational metrics, or profitability could more or less equate what you did in FY20?
We had a very good FY20, and some of it was because of exceptional market circumstances. Nonetheless, keeping that in mind, we remain reasonably bullish about FY21. If you look at it in comparison to FY20, then I guess that you should be seeing a plus minus similar, but we look forward to FY22 continuing on a growth trajectory. But FY21 certainly is not a washout year for us.
Yeah, I mean, and I don't want to get into exact numbers. Now, slightly some trend-related questions, Maulik. The China plus one narrative has probably only accelerated what people thought would happen for specific pockets. It's being witnessed in APIs and pharma. It's witnessed in specialty chemicals, maybe some of your products as well. Now, I want to understand from you, because it also ties in with the earlier comment that you made about resuming conversations with partners, etc. Are you, in the spaces that you are present in, seeing people actively wanting to partner your company or shift maybe orders in specific segments, etc., to India and to products that Deepak Nitrite manufactures? Are you seeing tangible evidence of that?
Yes to both. Cautiously, yes to both. China is a very, very large producer and consumer and exporter. So China must never be underestimated. It is extremely innovative, and as a competition, it is the best kind. Nonetheless, a lot of companies worldwide, for various socio-political issues, environment-related issues, and some cases legal and IP-related issues, have started looking very deeply at other opportunities where they're not looking at reducing the relationship with China, but they're looking at reducing the risk of over dependence on China. And therefore, India is at a pole position assuming that it's able to get a lot of its current challenges together, which the government is already tackling very seriously. And on the front of India, India is not only a worthy market in order to manufacture, but it is also a large consumer in its own right. Along with that, companies like Deepak, which are not only accredited with responsible care, but are part of the Nicer Globe Alliance with many of the European multinationals, and the Together for Sustainability initiative, again, with many multinationals. In a lot of ways, India and Deepak in particular are looked at as attractive destinations for partnering for value-added chemical intermediates. Deepak has another benefit that it can put on the table, and that is its significant presence across products in particular value chains. And therefore, it allows us to be able to project an element of sustainability and product quality, which may be a little bit more difficult for fly-by-night operators or new entrants. And this has remained not only an attractive feature for companies that are talking to Deepak, but in a couple of cases, it has actually increased its attractiveness over the last year.
Interesting. Can I get one sense though? I see, and I'm not saying which side is better, but I see companies in specialty chemicals and otherwise in pharma, etc., who are happy being, for lack of a better word, contract manufacturers or back-end manufacturers for a long tail project, let's say 10 years, 15 years, etc. I mean, we've seen RT, for example, do that. Are you saying that, or am I understanding you correctly, that you may not want to do that? You may want to partner in a product and jointly kind of launch it or something like that? Or would you also be open to doing back-end manufacturing because of your manufacturing strengths?
So let me just tell you, Neeraj, we have we are actually celebrating our 50th year. The company actually got incorporated in 1970. And so therefore 2020 is an important year for us. And we like to say that we're now 50 years younger. But over and above that, there is a major initiative that we have taken internally called Depend on Deepak. And Depend on Deepak means different things to different stakeholders, internal and external. So when we're talking about current customers and future customers, there is a particular aspect of it which is very attractive to them. And I'm looping into your question. Deepak, we don't look at it as if it is specialty chemicals and commodity chemicals. We're chemical intermediate manufacturers and with deep process competency. And we have a good amount of long-term orders in commodity products and long-term strategic relationships in specialty products. So when we come into the market and when potential customers talk to us, they talk to us because we have a significant presence and we have been able to demonstrate sustainable quality and consistency in supplying those value-added chemicals. And that is, in my opinion, the biggest attractive feature of Deepak, that we are never in a position where we are forced to pick and choose whether to invest into basic chemicals, what you may call commodity, or specialty, because both of them are able to synergize very nicely with each other. And that is what we believe in the long term. Whatever the markets say, this is where we believe in the long term that the dependability on Deepak will always be one level over someone who is a pure play CRAMS manufacturer.
Yeah, no, okay. So I would want to maybe ask you a question on that too, but just before that, what I was trying to get was that would you enter into supply chain arrangements with a global company? Let's say a global MNC wants you to set up a plant or set up a manufacturing capability to be the back-end supplier for them for a 15-year, 20-year project. Would you be comfortable doing that?
Those are some of the conversations that we are having.
Okay. But I'm guessing you're not at liberty to talk about them.
To let you know, we have had a lot of experience in this, even if these are not literally legal tied down documents, where we have been supplying to certain customers for the same product for over 15 years now, in some cases even more.
Okay.
Some cases 3 years, 5 years, 10 years. We just don't put it out into the public domain that this is a long-term contract. because a lot of this is based on a strategic partnership, which we have been, a very strong ally to. The customer in these cases, in many cases, has therefore been able to look forward into developing their own value adds because
Got
they're
it.
able to depend on Deepak for the last, decade and a half.
Okay.
And in any case, now we are talking actively about, long-term commitments as well.
Sure. So can I ask you, while you already answered that you don't look at yourself as a base chemical versus a specialty chemical manufacturer, but the narrative in the last 6 months, in a lot of in the minds of a lot of people, is whether Deepak is moving in a way wherein you build the building blocks via the phenol plant or otherwise, uh, for producing base chemicals and then building up specialty or derivative capabilities on top of it, which are margin uh, enhancing end products of sorts. Are you indeed thinking of that? I mean, can somebody envisage that at some point of time this India's largest phenol capacity that you set up could completely get used captively for eventually producing value-added specialty products which are more margin accretive?
Okay, so Neeraj, of course, the market is going to. It's important for the market to try to pigeonhole because then they are able to add aspects about, the industry, positive and negative, to companies like Deepak, and allows them to take the right call. However, let me put it this way: in our 50-year experience, we have never entirely vacated a market that we have taken up. And therefore, when we look at going downstream, we normally look at going downstream and continuing to service the segment that we have been focusing on upstream. If this involves augmenting capacity, so be it. And we are absolutely not only not averse to that, but we have actively done that. I hope that answers your question about phenol specifically. And even otherwise, as a company, we don't really see that the last 50 years, what we have done, where we have gone downstream from existing platform plays, has been a strategy that has proved anything less than very meritorious. And I will also say that if you look at Deepak 5 years ago and you look at Deepak today, certainly there is a significant difference. We expect that that will be the same situation 5 years from now, where the Deepak that will be there in 2025 will be quite different from the Deepak that is there today, hopefully for the better. But we are not, as I mentioned, in the habit of vacating a market just because we want to develop value-added downstreams. Our customers have also been sticky, they have been strategic, and they know that when we enter a market, we enter it to be a long-term player. We also look at augmenting capacity. We also look at going downstream as and when the value presents itself, but not at the expense of the upstream.
That does answer my question. But what? Okay, then let me try and rephrase this. If we indeed look at Deepak in 2025 as a very different Deepak, hopefully for the better, in your own words, that may not happen because you're vacating an existing category. Just that you're augmenting capacities and capabilities in the spaces where the current existing base capacities allow you to build on the others, right? So as a proportion of base versus specialty, and again, I repeat, I'm not saying one is bad over the other. I'm no one to make the judgment. You are the person who's running the business. But as a proportion, from a financial investor's perspective, of base versus specialty, how do you see that pie moving 5 years out, let's say, since you invoke 2025?
Okay, so that's actually a very interesting question. Let me tell you, a few years ago, we had to deal with this exact same question. In 2016, we had to answer this question. We had just, put in our major funding for the phenol project, and it was about to come online. And, the China Plus One narrative had already begun at that point. And this was a very hard question for us. Should we compromise on, our financial prudence and look at growth as a trajectory? And we took actively a decision that the first thing that we need to do is not just run with the narrative, but we need to build our own strategic assets and pillars. And therefore, over the last 3 years, we focused a lot on improving our balance sheet. Deepak Nitrite now is a zero debt company. We invested heavily into R&D. We doubled our investment and then we doubled it again. We're putting up a brand new R&D center. And along with that, we also bought large strategic land banks. And therefore, we said, okay, let's say that the next 3 years, from 2016 to 2020, next 4 years, the focus is going to be on consolidating our advantage. And then the focus will be on growth. And therefore, now we are in a position where we're able to focus on growth. And we have a strong balance sheet. We have a good war chest. We have our other strategic pillars in line. And we're in a position right now where we haven't had to make very difficult compromises between choosing basic chemicals and upstream integration and specialty chemicals and downstream integration. So what we have already seen, the discussions that we're having, and we have a lot of active considerations that you will see over the next year and a half, where we are not in a position where we have to pick and choose. We're investing about 400 crores this year, and a good amount of that is with basic, and also a good amount of that is with specialty. And that we anticipate moving forward that we will be able to invest in both sides, on profit maximization and on new product and process improvement growth.
Okay, I'm certain you can't talk too much about your plans because they are in the formation process. But there's this new subsidiary announcement that you guys did about a week, 10 days or 15 days back.
Right.
What's that about? Is it a new business plan? Is it maybe somebody was telling me that it'll help you in getting tax benefits as well? Can you talk about that?
Yeah, sure. So first of all, the major aspect about the new subsidiary is that it incorporates process competency from both Deepak Nitrite and Deepak Phenolics.
Okay.
And therefore, it was important for us to have a new platform where we are able to synergize both. Other than that, by and large, the subsidiary is going to do what Deepak does best, which is use existing and new process competencies that we have developed and manufacture value-added intermediates in both basic and in specialty segments. And as you rightly mentioned, the most interesting part of that, which it's too early for us to get into details of, is going to be the unique business model of the subsidiary. And this business model will allow us a set of opportunities which are very different from what the current business model in nitrite or in phenolics affords us. So putting all of these things together, all the other benefits, if any, they are secondary in nature, frankly speaking. But this allows us a lot of leeway into how to strategically grow the new subsidiary.
Got it. Just that, Maulik, now your reputation precedes you. So after what you've done with Deepak Phenolics, by setting up something which was world scale, the expectations will only be that much higher. But nevertheless, a little bit about the numbers that have come in thus far and what do they indicate. So, for example, it's admirable what you've done with the operational metrics at Phenolics, right? I was looking at the numbers. I think Q1 FY19 or FY20, Q1 FY20, you probably were at 5-6% margins. You've scaled them up to about 20 or 22 in Q2 FY21 currently. Is this a new normal? Why or why not?
Okay, so let me say that in Q2, frankly speaking, the market continued to be challenging, both domestic and on an international basis. The prices were really not very attractive. So what you're seeing in terms of the improvement is the significant effort that has been taken by the plant team, by the logistics team, and the marketing team. We actually increased our exports from last year to this quarter by 500% because the domestic segment was still in its recovery phase. So I will, this is a very loaded question, very forward-looking question, but I will say that this improvement that you're seeing between last year and this year is purely because of the significant effort made by the teams involved, and not because of any significant market dynamics that worked in our favor. I think the only small thing that we were able to take advantage of, and even that was not as large as it was the previous quarter, was the depreciated rupee. But even there, it came back to, I think, about 73, which was not very different from what it was pre-COVID. Nonetheless, we're looking forward to this being sustainable, at least in the medium term.
Okay. And therefore, I would deduce that if indeed the market dynamics change, then it could only get better. But I won't hold you to it. The other one is the finance specialty business, right? Wherein not only have your margins improved, but I think in Q2 you probably might have clocked in on the revenue front amongst the highest revenues they have clocked in that segment. So again, is that a new normal both on the margin front and the revenue front, more importantly? And can it actually move up FY22 onwards?
We're expecting it to move up in FY22, but in FY21, again, I will just reiterate, there are two things that we are doing. One is we have looked at significantly improving our operational processes. We have been able to generate a lot more value from waste, which is something that the last 2 years of the environmental concerns and all impelled us to do. Other than that, we have also tied up a lot of our products into medium-term contracts, and therefore we expect that by and large we should continue to see these kinds of numbers in the short term. We're looking forward to having them grow with our brownfield expansions coming into play soon, and also with new products that we're looking forward to adding in the next year or 2 years.
The other two segments, Maulik, very quickly, base chemicals, again, I think the operational metrics have looked okay. The one that did really well for you in FY20, unfortunately for you, TASDA and OBA, have just come off quite significantly. Are these trough levels for that business, and do you reckon that things could improve, or is it difficult to predict?
Okay, so let me just attend to performance products first. It's unfortunate that we have to compare the best and the worst, literally sequentially. But I will say that last year was an abnormal high, and we have been repeating in literally every investor con call that we do not expect this to stay. I will also add that as a company, our management has always been a little bit more conservative on exceptional things than out in the market, and we did not expect it to stay. In fact, it actually stayed longer than we had originally projected. Nonetheless, this year, what we are seeing is largely the impact of COVID on this segment, because the end segment, the end industries that it caters to, paper, detergents, and textiles, all have been extremely subdued over the last 6 months. So I will not say that last year was normal, and I will also not say that these last 2 quarters have been normal for this segment. We're already starting to see an uptick in demand volumes in Q3. And if this trend continues, then you will definitely see Q3 and Q4 numbers move up compared to what was there in Q1 and Q2. What the new normal will be is difficult for us to project right now, but we anticipate that this will come back to whatever that new normal is over the next maybe 2, 3, 4 quarters. And at that time, it will be a good opportunity to talk about whether that is sustainable. I believe that it will be. But I would hasten just to remind that the last 2 quarters and the year before should not be looked at as the right numbers and the right returns for that segment. In terms of basic chemicals, there were 2 challenges. One was the end industry. A large amount of basic chemicals actually goes into the dyes and intermediate segment, and a large amount of those are in the MSME sector. Now, the MSME sector had a protracted recovery for its own challenges, but it is definitely on its path up. So we are already seeing, in terms of demand volume recovery, there is definitely an improvement in Q3. We hope to see it continue in Q4. Also, in the early parts of Q2, we were constrained when it came to operations, because manpower also in terms of ensuring that what we focused on was safety of people, assets, and material. As a chemical manufacturer, these things can often get overlooked because there is a paucity of manpower, and we did not want that to happen. We invested a lot of time in doing our what if scenario analysis. What if we have a situation where 30, 40, 50% of our workforce is COVID positive at the same time? What is our fallback? How can we mitigate a lot of these issues? What do we have to do outside and inside of the company to ensure safety of our people and our assets?
Sure.
And therefore, we had a slow production earlier on in the quarter. We kept safety as a far more important consideration. I think in quarter 3, barring any unforeseen challenges, we should be able to manufacture a lot more than we made in Q2. And anyways, in the market, we're seeing signs of demand recovery. I would expect that basic chemicals will see definitely a better Q3 than Q2. But what's also important is that we will be able to maintain the EBITDA percentage.
Yeah, which is crucial. By the way, I like the way you're talking about the manpower issues. It was commendable what you said on the call, that if indeed it's necessary to keep the plant shut for the safety of the employees, you'll go ahead and do it. So kudos on that. Just one couple of quick questions, Maulik. What does all of this do to return ratios? You have seen them improve. We've seen them improve the blended return ratios, ROC, ROE, over the last 2-3 years at least, if not longer. Do you see scope for these to move up further?
I would say that the last 10 years have seen, in some cases, doubling or even a tripling in terms of improvement on these ratios. The management is hard at work to maintain these ratios and look at every opportunity for improvement, but sustainable improvement. Our improvement focus is never with regards to just short-term tactical benefit. It has to be something where we're investing and we are expecting sustainability in the improvements. Again, this comes back to our original focus in not just this year, but moving forward as well, which is depend on Deepak. And these are questions that we ask ourselves. What would investors look at when depending on Deepak? What would employees look at? So when you mentioned about taking safety as a priority, we asked ourselves, what would employees look at when depending on Deepak? And safety, livelihood, these are the things that they would depend on. Growth opportunities internally is also what they would depend on. New learning is what they would depend on, and we invested in that. And when we look at investors, we know that investors are not looking at 1 or 2 years of outstanding performance and then back to lower normal. We are expecting that investors will look at Deepak as a sustainable engine of growth. So when we look at our ratios, our focus has to be not on short-term improvement for a particular year and come back to another lower number. It has to be something where year on year we're able to demonstrate that these ratios are sustainable.
Sustainable or improving. But you believe that it will at least be sustainable, if not improving. Fair call. One final question. Sorry, Maulik, you want to make a point?
No, you're absolutely right. This is where we are focusing.
Okay, my last question, and that is, you took a large leap of faith, right? When you guys set up the phenol plant, you took on debt, set up a phenol plant, and then worked towards bringing it down. You're looking at newer opportunities. You've spoken about how FY22, the capex plans would be higher. You have a new subsidiary. International conversations are on. Is there a large leap of faith project coming up? You may not be able to divulge details, but my question is, would you do a string of pearls expansion strategy, or could it be a large one-off project that could come up the way phenol came up a few years back?
I think as a company, because now we are definitely a larger company, I would say that phenol was a big leap of faith, 5-6 years ago. As a company, we were much smaller, and therefore it was, a large growth. But I think that over the next few years, we're in a position where we're able to take a lot of, medium-term opportunities, which, if you're looking at it in terms of value, we're okay. If you're looking at it in terms of quantum jumps, Our focus right now is to prioritize the, I won't say string of pearls because it's definitely more than a string of pearls, but we do have a target, as I mentioned internally, of looking at a company 5 years down the line, which is very different from what it is today. And that comes not only with the amount of capital that we invest, it also comes with the other strategic aspects that we focus on, which is a lot of R&D intensive new products that are coming up, which is also adding new platform plays and large capacities to augment those. And it is also looking at various integrations which tomorrow will retain sustainable benefits because they consist of entry barriers. So I'm sorry that I'm giving you a very evasive answer, but the real truth of it is that we are projecting good amount of large investments, also a good amount of medium investments. But looking at them all together, it's definitely one where we don't have to take a huge leap of faith. It is one where we are able to constantly back up. And in this, we are happy to look at various different funding options, whether we are looking at taking debt or other opportunities. But as a company, we have always been very conservative with taking the opportunities. Funding is not a problem, but we will remain conservative in our gearing ratio. We get uncomfortable when it goes close to 1 or above. So we would be happy to see how we can ensure that it remains conservative. And we've already made the right kind of investments to ensure that we are not overstretching ourselves.
Okay. Maulik, this was lovely talking to you to get a summation of some of the plans that you have. Thank you so much for sparing the time, and wishing you and all of your fellow colleagues at Deepak Nitrite festive greetings, happy Diwali, and a very prosperous new year.
Thank you, Neeraj. And the same to you. Please stay safe. And I hope that everybody gets to celebrate, keeping in mind that this year it has had its fair share of challenges, but it has brought out the best in all of us. Thank you, everybody, and thank you to the Bloomberg team. Have a great year ahead.
Likewise, Maulik. Thanks so much for joining in, viewers. Thanks so much for tuning in to this edition of The Talking Point.